Hello everyone. We'll now be talking about one of the important accounting standards, financial reporting standards examinable in the ACCA Advanced Audit and Assurance exam, and that is International Accounting Standard 10, Events After the Reporting Period. Events after the reporting period is an accounting standard that is very frequently examined in your Advanced Audit and Assurance exam. So you need to be very clear on the principles that underpin this standard. You should be able to apply them to the case study scenarios. I would use a practical example to illustrate the concept. And for that, I'll be just sharing my screen with you. This is a company, a real world company, which has its notes to the unconsolidated financial statements for the year ended 31st December 2019. I hope all of you can see the year end over here, 31st December 2019. So it means that the statement of financial position would be as at 31st December 2019, and the profit and loss account would be for the year ended 31st December 2019. Now here you would see a note. If you can all see this note number 46, this note, date of authorization for issue. These unconsolidated financial statements were authorized for issue on 13th March 2020 by the board of directors of the company. So the year end is, I hope you can all see, you've already seen the year end. The year end of the company is 31st December 2019. The year end of the company is 31st December 2019. And on the other hand, the financial statements were authorized for issue on 13th March 2020. Now, what is the link? The link between these two dates is that whatever events happen between 31st December 2019 and up till 13th March 2020, that is January, February, and up till 13th March 2020, whatever events happen, they may need to be reflected in the financial statements. I've used the word they may need to be reflected in the financial statements. By reflection in the financial statements means that they need to be somewhat depicted. They need to be somewhat incorporated in the financial statements for what year? For 31st December 19 accounts. So now I would be sharing another screen with you to illustrate this principle, the basic principles of IAS 10, and that is IAS 10 events after the reporting period. So events that occur between the end of the reporting period and the date when financial statements are authorized for issue. In the example that, in the real world example that we've just seen, you all must have noticed that the end of the reporting period was 31st December 2019, and financial statements were authorized for issue by the board on 13th March 2020. So between these two dates, whatever favorable or unfavorable events that occur, they are termed as events after the reporting period. I've already told you that they need to be somewhat reflected or incorporated in the financial statements. How they have to be incorporated or reflected depends on the type of event after the reporting period, because there are two types of events after the reporting period. One is adjusting events and the other is non-adjusting events. So after the reporting, end of the reporting period and before and till the date the financial statements are authorized for issue, there could either be adjusting events or they could be non-adjusting events. Now let's first understand what are adjusting events. So this table actually gives you a high-level snapshot summary of adjusting events, the definition of adjusting events, some examples, and then the accounting treatment of those events. As far as adjusting events are concerned, they are events that provide evidence of conditions that existed at the reporting date. By reporting date, we mean the balance sheet date or the date as on which the statement of financial position is prepared. So there are certain events that provide evidence of conditions which were already there on the reporting date. Some examples could help to clarify this further. For example, there was a ongoing litigation. The company had a litigation with its supplier or its customer, whatever, as at the year end, but the court at that time had not announced or given any decision or judgment on that particular litigation. So subsequent to year end, suppose 15th January 2020, the court gives out a decision and says that the company would have to pay, for example, a fine or a penalty or a damages of $5,000 or $500,000, whatever the case may be. So in that case, because this outcome of litigation, although this has came after the year end, but because this litigation, the same litigation existed at the reporting date as well. So it is only an additional information which has confirmed or clarified certain things. So you would call it an adjusting event. Likewise, another example could be bankruptcy of a customer after reporting period. Usually when a customer goes bankrupt after and you came to know about it post year end, usually that is treated as an adjusting event. Why? Because bankruptcy doesn't happen overnight. There must be conditions and issues that were ongoing with that particular customer, and it's only that finally it has culminated, the conditions and the issues translated into the bankruptcy of a customer. So you would treat it, you would consider it as an adjusting event. Now, for all these types of events that provide evidence of conditions that existed at the reporting date, always remember the accounting treatment. The accounting treatment is to adjust the amounts recognized in the financial statements. To adjust the amounts recognized in the financial statements, or I would convert it into capital, or recognize items previously not recognized. So, for example, in the first example, if you had no provision recognized for that particular court case, which the decision of which was announced against the company post year end, you would have to recognize a provision. So this is, you are recognizing an item that was previously not recognized. On the other hand, you had a receivable recognized on your balance sheet, on your statement of financial position, but post year end you get to know of the bankruptcy of a customer, and in that case you would actually recognize, in that case you would actually adjust the recognized receivable by recognizing an impairment loss or by writing off that debt. So that's precisely what an adjusting event is all about. The other category of event after the reporting period is non-adjusting events. Now, what are non-adjusting events? Non-adjusting events are events that are indicative of conditions that arose after the reporting date. So non-adjusting events are events that took place after the year end, and they do not provide evidence of conditions that existed at the reporting date. They're totally independent of what happened as at the reporting date or before the reporting date. They're completely independent. For example, dividends declared after year end. If a company has declared some dividend post year end, that is an example of a non-adjusting event, because that's an event which happened altogether after the year end. If a company had declared dividend before the year end, then obviously the company would have to recognize the liability for that. But because the dividend has been declared after year end, it will be treated as a non-adjusting event. Then another very popular example is destruction of a major production plant due to fire after reporting period. Destruction of a major production plant due to fire after reporting period. A fire incident took place after the year end, right? And it damaged your inventory, your production plant. So that's an example of a non-adjusting event. Now, here, there's one trick over here that I would be talking about shortly. But for these sort of non-adjusting events, which are indicative of conditions that arose after the reporting date and that those conditions did not exist at the reporting date, for such non-adjusting event, what is the correct accounting treatment? Remember, the correct accounting treatment is that you have to disclose those non-adjusting events. But the important thing is if they are material. So the first thing is the management responsible for the preparation of the financial statements would have to evaluate whether those non-adjusting events are material. And if the management concludes that yes, those non-adjusting events are material, then the management would have to disclose them in the notes to the financial statements. And it is important to appreciate what exactly the management would have to disclose pertaining to those non-adjusting events. What sort of disclosures would be required? The management would have to disclose the nature of the event. The management would have to disclose what? The nature of that non-adjusting event. For example, that it's a dividend declaration, and financial impact estimate, that what is the financial consequences of that particular event that the management has to disclose. Or in circumstances where it's a peculiar situation, where it's an abnormal, unusual situation, or a situation of a continuously evolutionary nature, a statement that such an estimate cannot be made. A statement that such an estimate cannot be made. So either you have to give the financial impact, or you have to say that financial impact cannot be ascertained or is not determinable for the time being. I would again take you to the real world example to illustrate these non-adjusting events. I hope you can all see this note 43. You can see what is this? Non-adjusting events after the statement of financial position date. So you would see here, the board of directors of the company in their meeting held on this date proposed a final cash dividend for the year ended December 31st, 2019 at 15%. That is rupees 1.5 per share. This is in addition to interim cash dividend, resulting in a total cash dividend for this. The approval of the members for the final dividend will be obtained at the forthcoming annual general meeting. The financial statements for the year ended December 31st, 2019 do not include the effect of final dividend, which will be accounted for in the financial statements for the year ending December 31st, 2020. So you see, the disclosure is very clear. It has talked about the nature of the event. It has talked about the financial implications of that event. And the disclosure has even served to clarify, that's an additional disclosure actually, that the effect of this dividend, this rupees 1.5 per share, which has been declared post year end on 13th March 2020, this dividend, it's just a disclosure, and that the financial consequences of the financial hit or the cash outflow of this dividend or the impact of this dividend will be accounted for in the financial statements for the next accounting period, because these are the financial statements for December 31st, 2019. Let's see another example. The shareholders of the company in their extraordinary general meeting held on February 25th, 2019 had approved acquisition of this number of ordinary shares at par value of this of Adamji Life Assurance Company Limited, ALACL, from IVM Intersurer BV at share price of rupees 16.68 per share for an aggregate price of rupees this. The company, after obtaining the approval for payment of State Bank of Pakistan, credited the sum to IBM's bank account on February 25th, 2020. After the acquisition of the aforementioned shares, ALACL has become a wholly owned subsidiary of the company. So you see, a major business combination has occurred post year end, but because that had happened post year end, so that is why it has only been disclosed in the notes to the financial statements. Even if you would look into the consolidated financial statements, Adamji Life Assurance Company, this company would not be consolidated for December 31st, 2019. However, for December 31st, 2020 accounts, the results of Adamji Life Assurance Company would actually be consolidated into the results of this company which has acquired it. I would also like to take another example. 43.3, another non-adjusting event. The company follows the development of the COVID-19 coronavirus and evaluates the extent to which this may affect the company's operations in the short and long term. With the high levels of uncertainty surrounding the situation and potential additional initiatives by authorities and customers, it is very difficult to predict the full financial impact that the situation may have on the company. So you see, this is an example where you cannot ascertain the, arrive at a reliable estimate, a reliable financial estimate of the transaction of the event. And so you're just detailing the nature of the event. You've told that it's COVID-19, it's a virus, that it will have implications for the company's operations both in the short term and long term. But then amidst the uncertainty that surrounds the situation, or that this particular virus has created, the full financial impact cannot be ascertained for the time being. So I'm again going back to the notes where we were discussing a snapshot. So I hope now you can better appreciate the distinction between adjusting, non-adjusting events. You can also differentiate how the two events are supposed to be accounted for, what is the appropriate accounting treatment in the books of accounts and the financial statements of the company. Last but not least, there's some specific guidance in this accounting standard regarding the use of going concern assumption. And what is that guidance? That guidance is, if management determines after reporting period that it intends or is forced to liquidate the entity or cease trading, that is, if the management determines after the reporting period that it is no longer a going concern, then financial statements shall not be prepared on a going concern basis. This is a very, very important point that you need to keep in mind, that although you've concluded post year end that the company is no longer a going concern, for example, if due to COVID-19 coronavirus situation, a company concludes after the year end, till December, the year end was December 31st, 2019. But after the year end, the company has concluded that because of the situation and the way it has evolved, the company will not be able to continue in operational existence for the foreseeable future. So if the company concludes that, then December 31st, 2019 accounts cannot be prepared. The entity is not permitted, the management is not permitted to prepare the December 31st, 2019 accounts on a going concern basis. Rather, the company would have to change the basis of accounting for December 31st, 2019 accounts as well, and would have to prepare the accounts or the financial statements on a non-going concern basis, that is a liquidation basis or a breakup basis. So that's basically a summary of the key principles that are pertinent in the context of advanced audit and assurance. I'm trying to keep the accounting standards lectures very focused towards what are the most highly or most likely examinable areas of these accounting standards. You've already covered these accounting standards in a lot more detail in your respective financial reporting and strategic business reporting exams. It's just a quick recap and a revision with a real life touch to supplement them so that you can have a more holistic perspective on these and how these are actually reflected in the accounting, in the financial statements of the company. There's one top tip for this particular accounting standard from an examination perspective, and that is, in your accounting exams, in your auditing exams, always be very mindful of the dates. Always in your examination, annotate your year end very clearly, mark your year end very clearly, and then after that, whatever date you read in the scenario, make it a habit to compare it with the year end, so that you can ascertain if it's an event after the reporting period. If it's a date that is after the year end, then it's an event after the reporting period. And after you have determined, after you have determined that it is an event after the reporting period, the next determination or the next thing to analyze is whether it is an adjusting event or a non-adjusting event. This is the most critical, the most important distinction that you need to create, that whether it is an adjusting event or a non-adjusting event. And depending upon how you have classified that particular event, you will be generating or you will be determining its accounting treatment. If it's an adjusting event, you would have to adjust the amounts recognized in the financial statements or recognize the items previously not recognized. And if it's a non-adjusting event, then you just have to disclose that only if it's a material non-adjusting event. And always remember, when it comes to disclosure, you need to mention in your examination, you need to specify that disclosure covers two things. One is the nature of the event and the other is the financial impact estimate. And if so, because another top tip that you need to take care of is, and that we will also be talking about in our risk assessment lectures, and that is the adequacy of disclosure. Why is it important to know what exactly a company is supposed to disclose, or why am I teaching you that for a non-adjusting event, what has to be disclosed, nature of the event and the impact, its financial estimate? It is important because sometimes disclosures are not omitted. I mean, they're there in the accounts, but then so you cannot say that the disclosure has been missed out or has been omitted, but many a times disclosures are there, but it's just that they're incomplete, they're inadequate. So adequacy of disclosure means that the contents of the disclosure are in conformity with the requirements of the particular accounting standard. So that's all about International Accounting Standard 10 events after the reporting period. I hope you've gained some clarity on how this will be examined in your classes, in your exam. And if there are any ambiguities, you can come up with your ambiguities through the multiple online platforms that have been made available to you. Take good care of yourselves.